problems. All right, so I'm going to finish talking about overlapping generations today. I'm going to defer my plan to save Social Security till a couple lectures from now, and I'm going to start to introduce uncertainty in this class. The exam will only cover the stuff up to basically the last problem set. So you can, there are a few things about overlapping generations I might say today which will clarify what you already know, but you don't have to know anything beyond the problem you turned in on Thursday. You're turning in today. So you, I think, are better informed now than you were yesterday. I think it's a big help to be doing the problems. So for those of you watching on screen at home, you know, do the problems. So remember we had a situation where there were generations, each of whom was rich when young and poor when old, that looked like that, and it went on forever. That was the only difference from what we've had before. People's lives were shorter than the lifetime of the economy, and to go to the extreme, the economy goes on forever, even though people only live 2 periods. And then there was land, 1, 1, 1, 1. So here's land, here's, and then there's there's land, and then there's generation, as I forgot the generation. Here's generation 0, generation 1, generation 2, generation 3, ... And time, this is time, and here's time 1, time 2, time 3, time 4, time 5, etc. Now this model, I've been told, is the hardest thing you do the entire class. Things are going to get much more complicated, but since they build up slowly, I think this model's the hardest thing that you have to do the entire class. So I realize it's a little bit confusing, but in the end, I don't think it's that complicated. And it reveals all the subtlety of Fisher's thinking. Not that Fisher understood about overlapping generations, but his ideas you can see here. So what are his ideas? You've got a complicated model in which you've got people trading apples when they're young against land. So the objects in the economy are land, which you're supposed to think of the stock market. Okay, so we've got land, and we've got land, yes, and we've got apples. So now what's interesting is the land is going to constantly change hands. So the young here are going to buy the land, but when they get old, they're going to sell the land. So the land is constantly changing hands. It's not that one person buys it at the beginning and holds it forever. So Fisher's formula, remember, was that the price of any asset was going to be equal to the discounted dividends. And the logic seemed to be at the time that the price, you know, if the person was going to buy the asset, they could take the money now, or they could wait and get all the dividends in the future, and they would compare, you know, what they would get out of the dividends in the future to what they have to give up today. But you see, in this example, it's a little more complicated. Nobody's going to hold the land and get all the dividends. Each person who buys the land knows that he's going to sell it long before the land is stopped, you know, before getting all the dividends from the land. And yet, the price of the land is still given by this formula. So we never used the fact in Fisher's argument that the same person had to hold the asset till the end. And so now we have a case, an extreme case, where people only hold the asset for 1 period. It's always turning over, turning over, turning over, but still the price of the asset is equal to the discounted dividends. So the secret to solving this problem, according to Fisher, is forget about the asset. That makes it too complicated. Fisher's argument, again, is take financial equilibrium. Maybe I should write it on a different board. Fisher's argument is financial equilibrium, okay. Get rid of assets, put dividends into endowments, and transform it into general equilibrium, the very thing you solved in the first couple days of class, okay, and then go backwards and figure out what the financial equilibrium is. So, although it seemed very easy before, it's a little subtler this time, but it's the same principle. Whose endowment should you put the dividends into? the land is changing hands all the time. There's a new guy owning it, a new guy owning it every period. So whose endowments do we increase when we put the dividends of the land into someone's endowment? You put it into the endowment of the guy who owned it first. So put dividends into endowments of original owners. Okay, so this old person who has the right to the first apple, his own endowment of an apple, and also the right to the first dividend, but he actually has a right to all the dividends. So his endowment, the endowment of Mr. Zero, okay, is going to be 2, 1, 1, 1, etc. Because he has his original apple, plus he's got, and he has his endowment of an apple, because everyone when they're old has an apple. He's also, because he's owned the land before, gotten the right to this first dividend of the apple, that's 2, and because he's the original owner of land, he owns all the future dividend streams of the land. Okay, so we can forget about land after we've stuck the dividends into the right person's endowment, and now we just trade as if it's general equilibrium. We just look for supply and demand and the present value prices, which are P1, P2, P3, etc. Okay, and because it's symmetric, we know that this is going to equal 1 P. We can always make one of them be, one price can be 1. So the present value prices are going to look like this. Okay, and the reason I can make this simplification is by symmetry. Every generation is the same. So it's obvious that I'll be able to keep repeating the same argument over and over again. Okay, and so what do I have to, okay, so remember the land has disappeared here. Even though this generation is buying the land and selling the land, in Fisher's story, you don't have to pay attention to that. This guy bought the land and then he sold the land. So he, it was a fair trade. So he started, he started without it and ended without it. The fact that in between he used the land to save, you can already do that in a general equilibrium. You don't need to think about the land, because the only reason this guy is buying the land is to use it for a means of saving, which is already in Fisher's equations. So to solve for equilibrium is then quite simple. We just, in every generation, we look at, and remember I forgot to write the utility functions, so we have U of consumption when young and old is 1/2 log young plus 1/2 log old. Okay, and so therefore in equilibrium we have to have that 1/2 times the income of every generation. Every generation is going to have 3 when young plus 1 when old. Now from the point of view of any generation T, the prices are P, say 2 when young and P3 when old. Now remember, any generation cares only about relative prices. So I can call them P2 or P3, or I can call them 1 and P, because the ratio is going to be P. So much simpler to think of the prices as 1 and P. So the old guy, okay, if I'm doing any T, like this period 4, the old guy here, that's P4 and P3. He cares about P3 and P4, but he only cares about the ratio of P3 and P4, which is P. So from his point of view, he might as well have thought of them as 1 and P. So his income is 3 plus 1P, and he's going to spend half his income on that good, which for him is a relative price of P. The young guy is going to spend half his income, which is also 3 plus 1P. This is the relative price between T minus 1 and T. This is the relative price between T and T plus 1. But he's now young, so his price when young is 1, and that has to equal 3 plus 1 plus 1 equals, so I wrote it as 1 plus 3 plus 1 equals 5. Okay? And we solved that, and we found that P equals 0.55. Okay? So are there any questions about how we did that? That's where we ended the last lecture. Is that clear to everyone? Yes? Okay. If I didn't have symmetry, I would have to say I would have to write this as, in general, this would be 3 pt minus 1 plus 1 pt over pt, and this guy would be 3 pt plus 1 pt plus 1 divided by pt. Right? That would be, in general, if I had prices, the present value prices, this guy's income would be given by that, because he's the old at time t, and the young would be given by that. Okay? And I'd have to do this, a new equation for every t. Who asked? You asked the question, right? So does that make sense? Okay, but I have to do that for every single t. So I have an infinite number of prices and an infinite number of equations. But then you say to yourself, well, you know, this is, if I take the ratio of pt over pt minus 1 to equal p, okay, then the ratio of these two prices is the same as this price. And so I've got, you know, I'll have one equation in one unknown variable, and that same equation will get repeated every other generation. Because when I go to generation, you know, s, which is another generation, all that matters is the ratio between pt minus 1 and pt and pt plus 1. So if I assume those ratios are always the same, I'm going to be repeating the same equation over and over again. So if I can solve it once, I can solve it an infinite number of times. It's basically the same equation written infinitely often. And so as long as I keep these ratios constant, I'm just doing it over and over again. So I only have to do it once. So so it doesn't have to work out that it's, you know, that it's just because, you know, every generation has the same endowments and every generation has the same utility. That's why it's such a simple thing to solve. Yeah.
Is the regular P before you erase this then a sort of a weighted price that becomes the old age consumption price because we assume young age price is 1?
The P, this P, is just the ratio between, this is how I got P. PT, okay, P is PT over PT minus 1, which also equals PT plus 1 over PT. The ratio of all the prices is always P. Okay, the ratio between time t and time t plus 1, this good is more valuable than that good. This good is only worth P is 0.55. It's only worth 55% of this good. And then this good here is only worth 55% of that good. So the symmetry assumption, you know, but the symmetry of the problem suggests that I could guess that the prices are going to, the present value prices are going to decline by the same percentage every period. So, okay, so any other questions? I mean, we'll keep going with questions. Yes?
Can you explain the E0 equals 2, 1, 1, 1?
Yeah, what is the endowment of the original old guy? He's the guy who owns the land. So what does he have? He has one apple when his endowment, when he's old, like everybody else who's old. He has an apple, you know, his own tree in his backyard gives him an apple when he's old, okay? Or, you know, when he's an old man or an old woman, he can sort of, you know, barely scrape together one apple. Now, he also has the land. The land is his for all time. So the land is paying an apple every year forever. So his own apple when he's, you know, at time 1 plus the land's apple is this 2, and the land's produced as an apple every time in the future. So that's his endowment. I stuck the dividends of the land into his endowment.
Are you assuming, is that like he lives forever, or are you just saying all the future dividends are part of his endowment?
Right, I'm not assuming he lives forever. He doesn't. In fact, he knows he's going to die in period 1. He wants to do all his consuming in period 1. But he has endowments. So that's another subtle thing about this. You can own endowments that, you know, occur after you're dead. You know, if you own a tree, the land is going to be producing stuff long after you're dead. So when you sell off the land, you're selling off those future dividends. Okay, of course, you're not going to hold the land. If you don't care about your children, you're not going to hold the land beyond the time you live because you want to just consume as much as you can. So you're going to sell off the land and consume. But you're selling off all of these future dividends. Okay, so another thing this model gives us is a new argument for the real interest rate, real R being greater than 0. So why is it? Because from this formula, gosh, I was so clever. Where did I? Oh, here. From the price of the asset is discounted dividends. That's going to be 1 over 1 plus R plus 1 over 1 plus R squared plus 1 over 1 plus R cubed plus dot, dot, dot. By the way, that's equal to P plus P squared plus P cubed, you notice. Okay, so the discounted value of the dividends is the price of land. So the price of land, of course, has to be finite, you know, because, I mean, if the old guy owned a thing worth an infinite amount of money, he'd sell it and he'd buy everything in the world. So if you're going to have equilibrium, you know, there's no plot of land that sells for for $100 trillion. The price of every plot of land is some finite amount. So if the land is producing, you know, I think it's sort of realistic. Land is probably going to produce forever. As long as the world lasts, if you've got land, you'll get something out of it. Someone will always want the land. And so if it's going to have a finite price, the whole future dividends have to be discounted to a finite number. If you put 0 in here for R, you get infinity. So this presence of land is forcing the discount rate above 0. Okay, so that's another argument that Fisher never would have thought of, because he never thought about infinities or anything like that. Another argument for the interest rate, real interest rate, being positive. Okay, any other questions about this? So we reduce it to one equation, and I'll put back the P here in just one unknown. Okay, equals 5, and we solve it and we get P equals 0.55. Okay, and it's a quadratic equation, so you can all solve quadratic equations. Now, in this, okay, what else do I want to say? So now, you could analyze all sorts of things. You could do the same comparative statics Fisher does. Suppose we changed the utility function and made this, you know, a third instead of a half. That would correspond to doing what? Making people more what? Impatient. Okay, and what would you think would happen to the interest rate? Go up. Okay, so in the Excel file, we're going to do just that. We're going to see it's going to go up. Instead, we could do the Social Security thing, and we could have every young person give something to the previous old, which means everybody's endowment goes from, say, 3 to 2 and 1 to 2. Okay, so they get more in the future and less in early on. So again, you could resolve for equilibrium, and Fisher's saying if you've got more endowment in the future and less in the present, you're going to have a higher real interest rate. So you get a higher real interest rate. You know, you could make the land more productive and change this to a 2 everywhere and see what happens. Okay, so in this Excel file, I do that. Maybe I'll come back to that. So we're going to do those experiments in a second. But now I want to do two more things before I end this. The first is, I want to say, suppose we had growth in the economy. So what if you had growth? Where am I going to add growth? Over here. I shouldn't have erased that. So let's have growth. Okay, what happens? Well, Tobin, you know, Yale's greatest economist after Irving Fisher, he said something which was 90% right, but not 100% right. He said, you know, I pointed out to him that I got these guys at Social Security, I worked with them, and, you know, anyway, these people at Social Security and the Social Security Administration calculated who were the biggest beneficiaries of Social Security, and it was Tobin's generation, the same generation as my father. And I said, look, it's your fault that Social Security is such a mess. You benefited, and I'm going to have to pay for it. And he, you know, just like you're feeling you're going to have to pay for it, so it's even worse for you, but even my generation's not getting a very good deal. Yours is getting a terrible deal. Tobin's got a great deal. And so he said to me, it's not his fault, it's my fault, because I didn't have enough children. Okay, so the question is, what happens if you know, what does that mean? So what Tobin meant is that if instead of having one child for every adult, okay, so every family has 2 children. In other words, instead of one child for every adult, so it goes 3, 1, 3, 1, 3, 1, we start doubling the, you know, the generations are growing through time. So since this is 30 years or something, we could think of the generations doubling. That wouldn't be such a fast growth rate. And so Tobin would say, you know, might have meant if you double the generations, you're going to have 6 and 2 is the endowment. You know, 2 guys at 3 and 1, which means 6 and 2. Then you're going to have 12 and 4. It's going to be a gigantic growth. And so each generation, when it's old, the young guys only have, if there's 6 and 2 here now, instead of, so I should use a different color. If I wrote 6 and 2 here, if I put 6 and 2 there, then each guy would have to, or 2 guys at 3 and 1, each 3-1 guy would only have to give up half, half of his endowment, half a unit, because there'd be 2 of them, each giving half a unit to the old guy, and each one, when he gets old, getting a full unit. So this guy would get a full unit, the next generation would only give up half a unit. And because there were 4 times as many people in the next generation, each of them would still give a half, making these 2 old guys get their full 1, and when they got old, they'd similarly get a full 1 each of them. So it would seem that if you had a faster growing population, then Social Security would be a much better deal, because the young would have to give up less to the old and still get fully paid back when they were old, and so Social Security wouldn't have been a problem. Okay, so why isn't that so why wasn't it our fault, my fault? In your generation, there's probably not going to have any more children than my generation. So what's the, is that true, Tobin's argument? Is it true that if we just had enough children, we could pay, no one would have to lose out in Social Security? We could make the original generation better off, and also every other generation after that better off? Yep.
I think it would raise interest rates so that even giving up a half to get one would be a loss in the real terms.
Right. Okay, exactly. And so you can't know that until you actually solve a model. So the point is that if the generations keep growing like that, the interest rate is going to go up, and so it's still going to be a loss, because although you're going to be trading off minus a half to get 1 as opposed to minus 1 to get 1, so this looks like a much better scenario. Once you get to this scenario, there's going to be a bigger interest rate. So remember, the present value of that trade is minus 1 plus 1 over 1 plus r. That's why it's negative, because r is positive. Here, it's minus a half plus 1 over 1 plus r. Okay, but that's a different r. That's an r, I'll put it at the top. That's in a new economy, a growing economy, and that r is going to be a bigger r. So you're going to, even though it's minus a half instead of 1, this thing's going to be small enough, so you still end up losing money. Okay, but you'd never know that unless you solved it. And in fact, it's still going to depend on a little delicate assumption. So I claim, so Tobin, by the way, never bothered to work this out. I claim that if you're going to be doubling the population like this, there are going to be a lot more people working on the land, and so the dividends of the land are probably going to grow at the same rate. So I would add a 2 here. I'd make the dividends of the land also double if the population doubled. Okay, so the land dividends are going to grow. And so now you can see why the interest rate has to go up, because the present value of the land still has to be a finite number, the present discounted value of the dividends. And if the dividends are growing, then the interest rate had better be growing even faster if you're going to make that a finite number. So sure enough, when you solve it, you're going to get a higher interest rate. Okay, and so how would you solve it? Let's say the growth rate equals 1 plus is g, so 1 plus g. The growth rate is g, and so every generation is 1 plus g times bigger the previous generation. So you can just change this equation very simply. What would you do? Well, for any generation, it's the same equation, except that you've got 1 plus g times as many old guys as you have, these are young guys. The number of young guys is 1 plus g times the number of old guys. So if it's generation t, so this would be 1 plus, at time t, this would be 1 plus g to the t minus 1, and this would get multiplied by 1 plus g to the t, okay, and then the dividend, 5, so everybody's endowment is also going up, so it would be, well, actually I screwed up, it would be the old guy 1 times 1 plus g to the t minus 1 plus the young guys times 1 plus g to the t plus the dividend times 1 plus g to the t, or t minus 1, whichever. Okay, so that's the new equation. And then you can divide through by 1 plus g to the t minus 1. So so this is for this is period t's market clearing equation. But you see I haven't, okay, because the number of old guys is, for each one of them is behaving like that, but they're now this many of them. And the young guys are behaving just as before, but there are this many of them, more of them. And then the endowments of the old have been grown that far. The old generation has this many endowments. The young has this much endowments when young. And then the land, we also assume, grew. Okay, so you can just now divide through by 1 plus g to the t minus 1, and that goes away. And that just leaves that. That goes away. And that goes away, and that goes away. So you'd have that equation. Oh, no. Yes. I was afraid someone was going to do that. Okay, so let's just see where I got this equation from. Okay, so I took my original equation, which didn't have any 1 plus g's in it, and I just said if I had growth in the economy, it's no big deal to take that into account. I'm still going to have one equation, so I can still solve it. It's just that at every time t, how many old guys do I have? I have each old guy behaving the same way as before, except that now, there's been a growth of 1 plus g. This is a generation before this one. So this generation is of size 1 plus g to the t minus 1. The young generation, which is one generation ahead, has grown by a factor of 1 plus g. So there's 1 plus g to the t of these guys. So I take their old demand, the same for each guy, but different number of guys, and the young generation's demand, and I have to set it equal to the supply. But that's just the old guy's endowment, so 1 for each old guy, and there are that many old guys, plus the young guy's endowment, same as before, and there are that many of them, plus the land, which I've also assumed has been doubling. 1 plus g is 2, so the land is also doubling. And I'm not sure whether I called this t or t minus 1, but either one, it's not going to make a big difference. Okay? So who asked the questions? You followed that, right? So now I just say I can simplify. I've got 1 plus g's everywhere, so I can cancel a lot of them out. That's all I did. So if I divide by 1 plus g to the t minus 1, I just get rid of the 1 plus g to the t minus 1s. I change 1 plus g to the t divided by 1 plus g to the t minus 1. That's just to the first power. I got rid of this one. I made this to the first power and this to the first power. Okay, so I can solve that perfectly easily. Okay, and I'll do that in Excel in a second. So, and then we can see what happens to everybody's utility. So, are there any questions about what I did here? Yes?
I know you said for the dividend it doesn't matter whether you use t or t minus 1.
Yeah, it's going to change the answer, but it's going to qualitatively be the same.
So if we were doing this numerically, would we still want to go to the old generation and use t minus 1?
Well, it depends whether when I do this I want to say this is 2, 4, 8, 16, or whether I want to call it 1, 2, 4, 8, 16. So I don't know which is the right thing to. Probably I should have done 1, 2, 4, 8. Probably the way I have it here, which is t minus 1. Okay, any other questions about this? Okay, so the last thing to do is to just do it numerically, because it's a pain to have to solve these. These quadratic things. It's only one equation, but it's still a pain to solve. And I happen to have written a file that you can use to solve these all automatically. Oh, this doesn't look too good. Okay, so the first case I did is I say, suppose A, that's the exponent for how patient you are, it's half. Okay, that's the first exponent. Half, half. So I always can make the log utilities, the two coefficients. So it's A log B. So I'm assuming utility here, U of young and old, is A log young plus B plus 1 minus A log old consumption. Okay, so A I took to be a half. That's just what we were figuring out. I took the endowments when young to be 3 and when old to be 1, and the land output to be 1 forever. And then whatever, the price is what I'm going to try and solve for. And so I solved the market clearing equation and squared it and, did Excel solver. And I got the consumption, which we figured out was 1775 when young, and when old was 3.225, which adds up to, the two of them add up to 5 together, just as we thought. And so I even calculated the utility of each of the people. I didn't take log utility. Actually, I wrote a monotonic transformation. I put y to the a, z to the 1 minus a. It was easier for me to, you get positive numbers. That's just that's e to the u. So I might as well describe utility as the exponent of u. Take e to it, so it's a positive number. When you do logs of small numbers, you get negatives, so that's easier to look at. So that's the utility. Okay. Now we can do Social Security. What happens with Social Security? The only effect of Social Security, remember, is the same model. You just take stuff away from the young and give it to the old. So nothing changes except the young's endowment goes down to 2 and the old's endowment goes up to 2. And then the rest of the model is exactly the same. And so, of course, it's going to give you a different price. PA is different. So PA is smaller. That means today's price of next year's good is smaller. That must be more discounting. So I did the interest rate, 1 over 1, 1 over 1 plus R equals P. So, P, the inverse of P is this thing. Okay, so the forward rate is 161%. And if you think of that as 30 years, that's an annualized 3.2% interest rate. Before, it was only a 2% interest rate annualized, right? Remember, we got the 1 plus R to be 181%, 1.81, so R is 81%. Okay, so this Social Security doubled the interest rate from 81% to 161%. Huge increase in the interest rate. So Social Security has raised the interest rate, and so you resolve the whole equilibrium, and it had, it didn't crush everybody, but everybody's utility went down, except for the very first generation. We know they won for free. Okay, but now I could do the same thing with growth. Okay, I could just solve that equation on the left, and so I plug in now the growth rate from generation to generation, 1 plus growth, and here I've got 2. Okay, so it doubles every period, just the example I did, and so I solve it. And you see that, of course, when the generation's growing and land is being more productive and there are more apples and stuff like that, there's just more for everybody to consume. It's actually made everybody better off. Okay, but now we see that Tobin, and the interest rate is higher, way higher, 247% instead of 161%. Okay, if I do now Social Security in the growing economy, every generation when young only has to give up half an apple and get a whole apple when old. So that raises the interest rate from 247% to 300%, annualized from 4% to 4.7%. Okay, so the rate of growth is faster now than the growth of the economy, right? This interest rate, 300% is faster than the rate of growth, which is 100%. So again, everybody is going to lose. They're going to go from 3.06. They're still going to lose by Social Security to go down to 3. But Tobin, I would say, is 90% right. Although more children doesn't solve the Social Security problem because it's going to increase the rate of interest. So you're still going to have losers. Nonetheless, the loss is now much smaller with lots of children than it was before. So Tobin, I would say, is 90% right. If only every generation would have more children, we still would have had a crisis in Social Security. We still would have had, every generation complaining it was getting a bad deal, but it would be a lot worse. It would be a lot less bad than it was before. Okay, so, and then I did this variant depending on, what we said, whether the growth was, whether I had a g to the t or a g to the t minus 1 there. It doesn't really change that much. Okay, so that's it. So you see, just by a very simple modification of the problem. You can resolve, you can just, it's just, the understanding is so much, at least in my mind, so much clearer now about what role growth plays. Having more children doesn't make the problem go away. It makes it better, but you can never make it grow away because the interest rate is always going to be higher than the rate of growth of the economy. Okay? So let's do one last experiment on this stuff. Okay, another problem to resolve. So this was a big, I wrote a paper. The newspapers were saying the same sorts of things, and I'll tell you what they were saying. Oh no, I didn't mistake. Sorry. Okay, so remember those pictures that we showed before of the stock market. If you take out inflation, the stock market seems to go in these waves where prices go up and then they come down, and prices go up and they come down, and prices go up and they come down. We've had 5 big waves of stock markets going up and coming down. We're now in a period where they've been coming down. The stock market is lower now than it was 10 years ago, correcting for inflation. In fact, even not correcting for inflation. So why would you expect that to happen? Is there any logic to that? So here's an old picture of the stock market. So I wrote this paper in 2005. So remember at the first class we had a picture like this. You can see the stock market going up and down, up and down, up and down, up and down, 5 waves. It's now come down further. This is like 2001 or 2, so it's come down way further than that. Okay, so is there any explanation for why that would happen? So here's an explanation I gave in a paper, which a lot of people in the newspapers were giving. I said, the baby boomers. I said, all these baby boomers like me, we're getting old, we're going to start selling our stocks, and so the stock market's going to go down. And so that's what newspapers were saying too. The difference is that the economists criticize the newspapers and me, and they say, oh, you're crazy, they said. The stock market, it can't be that the stock market is going to go down, and everybody knows it's going to go down, because if we knew it was going to go down in the future, it would have already gone down now. And so you have to give an argument. So what I pointed out was that if you look at the history of live births, you get the same cycle. Look, it went up and down, up and down. I don't know if you can read that. I can hardly read it myself. What years are these? Why is it so unreadable? Let's just see if I blow it up a little bit, whether that... Okay, now I can see it. Okay, so this is 1910, 20, 30, 40, 50, 60, 70, 80, 90, 2000. So you can see these are live births. So there was a baby boom and then a plummet. And another huge baby boom, that's the famous baby boom, my baby boom, and then a plummet. And then there was another baby boom, I forgot what they call it, the X generation or whatever it is, some other baby boom that happened. Basically my baby boomers, me having lots of, having children, another big baby boom, and then birth rates are going to go down. So I think that you are, the number of 18-year-olds in the country is, at its all-time high, or is going to be in 2 years when my poor son tries to get into college. And so and then it's going to go down again. So this is a cyclical thing that keeps happening over and over again with baby booms and busts. And everybody knows about the baby boom after the war, my generation, the 50s and 60s, when I was born. Everybody knows about that, but they don't realize that there's been baby boom after baby boom after baby boom, and this is a cyclical phenomenon. And then the thing they really don't know is that it's exactly the same as the stock market, that the stock market followed, those 5 patterns in the stock market were the same patterns of the baby boom. Okay, so I'm going to end with that picture. So, so a picture is worth 1,000 words, but it's not that compelling an argument. You need a little bit of analytics. Suppose everybody knew that generations were going to get bigger and then smaller and then bigger and then smaller. Would the stock market go up and then down and then up and then down, as I was saying and as all these newspaper columnists were saying, or would it just stay the same as these less imaginative economists critiquers were saying that it couldn't have anything to do with demography because by rationality people would look forward and they'd anticipate it going down and so they'd all sell before it went down so it would never go down. And okay, so it turns out it does go up and down, okay? And that argument the economists gave doesn't make any sense because they were implicitly assuming that the rate of interest stayed the same the whole time. And if the rate of interest doesn't stay the same, then there's no reason why the stock market has to stay the same. So let's go back to where we were before and change the model a little bit. So let's suppose that the model is an alternation between big generations and small generations. So let's suppose that you have 6-2, 3-1, and 6-2. And I think I kept, so it's a good question, what should I do with land? I think I kept it at 1 every period. God, I hope that wasn't the key to the result. Okay, so in the paper, of course, I had, people living 80 years, and I had their income, reflecting the sort of trend in income over the lifetime. But anyway, for the purposes of this class, let's say there's a small generation where it goes, young 3, old 1. Then the next generation, which is just 2 guys, so they're both 3-1 guys, so in aggregate they're going to be 6-2. The next generation is 3-1, the next generation 6-2, the next generation is 3-1, and it keeps alternating like that forever. Okay, now, how would you solve for equilibrium? Does the whole thing get just much more complicated? I mean, what happens after all? Are there any questions here about what we're doing? So it looks way more complicated, but it's not. It's a little bit more complicated, but not much. You can still solve for this. Okay, so I'm going to not spend too much time on this but I'm just going to show you what you would do. So what would you do? Well, by symmetry, I claim you can guess that there are going to be 2 prices. So you notice that every generation only cares about the relative price between when it's young and when it's old. So there's this relative price. That relative price between consumption at time 1 and time 2, that's going to affect the generation born at time 1. It actually has no effect on any other generation. These generations are born after that. So this interest rate, this relative price between these 2 periods, affects only one generation. Okay, so this generation is affected by the interest rate between time 2 and time 3. This generation is affected by the interest rate between time 3 and time 4. Every generation is responding to the interest rates during its life, not during another generation's life. So by symmetry, I think you could guess, and it turns out to be true, that there's going to be a price, a relative price, I should call them small, relative price for the small generation and a relative price for the big generation. Okay, and the same thing is going to happen. So this is going to be, this relative price will be P small, this will be P big, and then we'll get P small again here, and P big connecting these guys. And it's just going to keep repeating itself over and over again. And by symmetry, you could guess that the equilibrium would look like that. Is this making sense? It's not making sense. Is it making sense? So what would I have to check to see that there's equilibrium? Well, any generation, so let's do it over here. Let's do a small generation. Oh, okay, so we never did the first. So the first generation, yeah, it depends on whether we start with a small one or a big one. But remember, if we can clear all the markets for all time except the first market, that one has to automatically clear. That's Fisher also, that was Walras's insight. Okay, so we know that if we can clear all these, the first one's going to look very different, but it's going to clear anyway, so I don't really have to worry about it. So we'll see why that works. So what are the generations? So I'm going to now talk about market clearing at any time except the first one, which is more complicated. The first one seems really complicated because there's this guy Zero who owns these dividends that go on forever. But of course, they're just worth the price of land, which he's going to sell off. So, but anyway, we'll come back to that in a second. So in every generation, every time period, you're either going to have when small generation is young, okay, what do you get? What's the market clearing equation going to be? Well, the small generation is going to be young, so that means the old generation is big. Sorry, so there's a half here. So the big old guys, their endowment is going to be 3, sorry, it's going to be 6. There are 2 of them, so I can multiply, I can put the 2 out here. 3 plus 1 P big, okay, divided by P big. That's the big old generation, plus, and the young generation, there's just they're the usual 3 plus 1 P young divided by 1, okay, has to equal, now how many endowments do we have? We've got 2 old guys plus, each owning 1, so that's 2 times 1, that's their endowment, plus 3, that's the young guys, plus the land dividend, so that's 6. So this should be P small, not Py, P small. No, I don't, because the old guys, the big generation is old, so small generation is young. So the young generation, they're consuming in their youth now, so they're looking at their endowment. The price when they're young is 1. So their young endowment is 3, their old endowment, their income is 3 times the price to them of 1 when they're young, plus the endowment of 1 when they're old times P small, divided by the price when they're young, which they're thinking of as 1, right? They only care about the relative price between young and old, and that relative price is determined by P small. So I could call it PT and PT plus 1, but I know that ratio is going to be P small. So really it only depends on the ratio, so I might as well just use the ratio, P small. This is a crucial idea that I've used 100 times, and I think I've used it now 3 or 4 times anyway, but I think some of you don't quite know what the hell I'm talking about. So somebody ask me a question if they don't know why this is right. Whoever just asked it, maybe you still don't know why it's right. Who asked this question a minute ago? Yes. Do you understand how I got this, or you do? Okay? But when the old guys, see the old guys, which is the big generation, we're clearing time, we're looking at this time. So the total endowment is 3 for the young generation. Their endowment is 2, and the 1 unit of land, that's where I got the total supply of 6. So this generation, when it's young, they care about the P small, the relative price between here and here. And so they're looking at P small, the relative price of 1 to P small. The old generation, at the same time, is looking over their lifetime at the ratio of consumption here to here, which is given by P big. So they've got a P big here, and they're consuming when old, so they're dividing by P big. Okay? But now we've got a second equation, which is when big generation is young. So why don't you tell me what that equation is going to be? How much is the endowment when the big generation is young? So that's maybe clearing at this time. Here the big generation is young, so what's the endowment? It's going to be the young. So the old, there's only going to be 1 old guy. There are going to be 2 young guys, each have endowment of 3, plus 1 unit of land, so that's 8. And you can see that adds up to 6 plus 1 plus 1 is 8. Okay, and what's their demand? What's the demand for the 2? So there's the old. What are the old going to be doing here? It's in this generation we're doing the market clearing. Somebody knows how to answer this. Yeah.
Don't they have 2 when they're old as well, so 2 times 3 plus 2?
Over here, the small generation only has 1 when it's old.
Big generation.
But big generation, that's over here. We're clearing at this time period. So there's a bunch of young guys and just a few old guys. So the endowments are 6 plus 1 plus 1. The time is going that way. So that's why that's an 8 over here. So 1 So this is the one old guy's endowment, 2 young guys who have 3 each, that's endowment of 6, plus the land is 1, so you get 8. That's how I got an 8 over there. That's the supply, so what's the demand? Who's trying to buy the stuff? What's the demand of the old guys?
They're going to spend all the resources they have.
So, and that's going to be what? They're planning to spend when they're old. Okay, we're doing this one. So when the point of they make their plans when they're young. They anticipate what the prices are going to be, and so how much do they plan to spend when they're old? 3 plus 1 P what? P what? What P? P small, exactly. Over P small plus, what are the young guys doing? We're over here. So 2, there are 2 of them. What's this? P what? Big, divided by, oh, there's a half here. Yeah, over what? 1. Okay, exactly. So that's it. So there are 2 equations and 2 unknowns, P big and P small, and 2 equations. So to solve this whole model, you could get 2 equations. You just have to solve these 2 simultaneous equations, which I did. Okay, now, and then you can find the effect. So all these old economists, the economist critiquers would say, well, P big should equal, okay, what will be the price of land, by the way? So what's the price of land going to be in the end? What's going to be the price of land, according to Fisher, at time 1? At time 1, let's say. So right here, what's the price of land? Remember, it's the price after the dividend is paid. So what's the price of land? Let's do the present value of the discounted dividends. What would it be? Maybe I better write it over here. Remember, the dividends are just 1 plus 1, 1 plus, so there's going to be 1 plus 1 plus 1 plus 1, but I'm going to be discounting, I'm going to be multiplying by something. So what is the price of land? P small, incidentally, equals, I could always write that as 1 over 1 plus R small. And I could write P big as 1 over 1 plus R big. Okay, so what's the price of land going to be? So it's the price of land starting here just after the dividend is paid. So it's very, it's hard to think about this. But if you can figure this out, then you've totally understood everything in the course, because this is so much more, it uses all the ideas in a just way more complicated way. Yes?
It's a geometric average of the R of small and R of big.
Well, start telling me the formula. So if I want to multiply, if I want to do the first terms, what is this first term?
It's R. R of small.
So you would put 1 plus R small here. Okay, and now what would you put over here? What?
1 plus R big.
You'd put 1 plus R big here.
Times 1 plus R small.
Okay, very good. So now you guys really know what's going on. And what would you put over here?
Times 1 plus R small.
Okay, exactly. 1 plus R small times 1 plus R big times 1 plus R small. Okay, that's that one. I'm going to stop with that. Too much. Okay, plus dot, dot, dot. Okay, so you have the idea now. What's the idea? Discounting between, you're taking the present value of all the dividends. So this dividend, you have to discount it by 1 plus R small. This one, you have to discount it twice. First to bring it back here, that's 1 plus R big. Then to bring it back here, that's another 1 plus R small. So 1 plus R big, 1 plus R small. The third dividend, you discount first at the small, discount, then at the big discount, then at the small discount, just like that. And you keep adding them. So why should the prices, what if you look at the price of land at time 2? Is it the same number as that? Is it the same formula? It's not the same formula because at time 2 you're starting here and the first discount is P big. Okay, so it's going to be 1 over 1 plus R big plus 1 over 1 plus R big times 1 plus R small plus 1 over 1 plus R big times 1 plus R small times 1 plus R big plus dot, dot, dot. So this isn't the same as that. Okay, it would only be the same as that if R big was equal to R small, if P small was equal to P big. So which one do you think is so which one do you think is bigger? You think P small is equal to P big, or one of them is bigger than the other? And why? That's the answer to the critic's puzzle. So you see, you've taken something that appeared in the newspapers. It sounds like common sense. If there are all these middle-aged people like me bidding up the, there were so many of us who want to hold stocks. We're at the peak of our earning power. We've got tremendous amounts of money. We want to, what are we going to do with it except put it into stocks? You'd think common sensibly the price of stocks would have to go up. When we get old and we're selling all our stocks, you'd think the price of stocks would have to go down. Okay, so that would tell you that the interest rate was going to be bigger or smaller. So that would suggest that the price at time 1, when the small generation was young, would be low, and the price at time 2 would be high. Okay, and that could happen if this interest rate was low and this interest rate was high. Okay, but does that happen or does that happen? You can't know until you solve it in a model. The critics said, oh, that can't be right because somehow, the price should even out and everybody will be looking ahead and buying or selling at the right time. You can't buy and sell at the right time because you're going to be dead. So you don't have much choice except when you're young here to save and when you're old here to dissave. So, they seem not to have overlooked that small problem. So anyway, okay, so the point is that to know the answer, you can't just reason it out verbally. You have to write down a model, solve for the model, and see what happens. And sure enough, it happens like, okay, so we'll go back to the paper now. Well, okay, are there any questions about this? Okay, so all I did in this spreadsheet is I wrote down those two equations. So you see that I've got the young and the old have the same half-half log utilities. The small generation is 3:1. The big generation is 6:2. Land is always producing 1 every period, and we get 2 different prices. The price is called PA. That's the A generation, which is the small generation, and the B generation, which is the big generation. So you can see that PA is a very small number when the generation is small, and that means the discount rate is very high. So a high interest rate when the generation is small, and a low interest rate when the generations are big. So in the money-making peak of the big generation, the real interest rate is small, and so that means you're not discounting very much. And so the prices are high of land. And so sure enough, the price when the small generation is young is 1.29, and when the big generation is young, it's 2.08, vastly higher. So it really is the case that as the generations rise and fall, the interest rates rise and fall, and the price of land rises and falls. And everybody's rational and anticipating everything. Okay, so there really is, it really could be. I'm not saying it's true, because it could be a coincidence that these things all matched up. But the fact is, demography can have a big effect on economic equilibrium in the stock market, and you can be an economist and believe in demography. You don't have to be a Marxist or something to think demography and fertility and all that stuff is going to affect the economy. And for a long time, economics tried to wall itself off from other social sciences and say, oh, those fertility people and all those touchy-feely people, it's got nothing to do with the real markets. Well, it has a lot to do with the real markets. Okay, so one last thing. Would you rather be in the small generation or the big generation? Of course, the answer's there, but tell me why. Yep. Okay, that's correct. So I'm screwed. And so why is that? Well, it turned out to be the utility of the, this is the utility of the big generation per person. Of course, adding the two people together, it's bigger. So per person was this, a lot less than the generation of the utility of the small. So why did that happen? Why exactly is that happening? So remember, I'm distinguishing sort of your peak, I'm calling young your peak earning years, and old, I'm calling the stuff when you're retired and not earning very much. So why is it that a high interest rate is good? Yes?
It encourages consumption today for the young generation.
Well, I think the point is, if you're making money when you're young and you've got a high interest rate, that means a high return. So you can make a big return through your life, whereas my generation had a very low return. The return I'm getting now is terrible. It's negative. So the return I'm getting now is just hideous. But when when my parents were young, they were making an astronomical return, incredible rates of return. Okay, and they were earning money, in their younger years and investing it to save when they were old, and they're getting incredibly high return. There's nothing to do with my money. There's so many people like me pouring money into the stock market, we're getting a very bad return, and that's why it's not so good to be part of a big generation. So other people had said the same thing. They said big generations have to squeeze into the same houses, so there's less housing stock, or we build more houses, the next generation comes along, there are all these houses built for them, and there are less of them to, so they get better houses, and everything's better when you're the small generation and you're screwed as the big generation, and here's an example of it. Okay, so that's it for Social Security, all the things I wanted to say about Social Security. Now, the exam, as I say, will end with, you won't have to do the 2 generations and all that stuff on the exam. But the first part about solving for the 0.55, that one you might have to do something like that. But anyway, the lesson that, you can have a controversy in the newspapers with arguments on both sides. You never can figure out the right answer till you write down a model. And the model can be very simple, the kind of thing you could do as an undergraduate. That's the lesson I'm trying to communicate. All right, so from now on, though, we have to change gears, and I think the course gets a lot more interesting, okay? But we needed all this background basics to have the logic of finance. But finance is really nothing without uncertainty. If you don't know what's going to happen tomorrow, that's when the thing gets interesting. That's when you have to think harder. That's when people make mistakes. That's when a hedge fund can make a profit. That's when, everything gets more exciting when there's uncertainty. And we have to start adding uncertainty to our thinking about the world. So since I only have a few minutes, I'm going to spend the last few minutes just reminding you of what you're supposed to know about uncertainty, which is this slide. Okay, so it's not a very complicated thing. Where's the, oh, I see PowerPoint. Okay, so there are 2 kinds of uncertainty, one of which we're never going to get to. So the uncertainty that we're going to work with in this course is everybody understands what could possibly happen. So this was a brilliant, states of the world model, it's called. So Leibniz is supposed to say states of the world right there. Leibniz was the one who first invented the idea of states of the world. He said we live in the best of all possible worlds. So if you don't know what's going to happen in the future, we're going to represent that as many potential states of the world. Now, there are other ways you could model uncertainty, and philosophy is a big, big subject in epistemology and philosophy. I'm going to stay closely to the states of the world thing. So if there's something about the world we don't know tomorrow, I'm not going to assume that it's just vague in our minds and, you know, we can't quite make it out. I'm going to assume you actually can make it out. It's just you don't know which of the possibilities are going to happen. So it's many states of the world. So a example of that, of course, is spinning a dice or spinning 2 dice. So you don't know, which of 36 possibilities is going to happen. Each of those would be one state of the world. Okay, so we can, so those are all the possible sums. So there are more states of the world than there are outcomes, notice. You can get 2 through 12 as the sum of the dice, but there's still 36 possible states of the world. And so that random variable, the sum of the 2 dice, is expressed as a function. It says in every state of the world, what is the random variable's value? So our state of the world, by that I mean something that's so detailed that it tells you the value of every random variable. So that's how I'm going to be thinking of uncertainty, that we're here today and a bunch of different things could happen tomorrow, and this is an exhaustive list of everything that can happen tomorrow. We're going to have to come back and criticize this assumption, but it introduces uncertainty in a way which is still quantifiable and not vague. Okay, so you can talk about the histogram of outcomes of the dice, how many ways, what chances are the chances of getting a 7, 6 out of 36, etc. So this is stuff I'm sure you all know. Okay, the most famous histogram in all of mathematics is the normal distribution, which I don't have time to explain. And so a normal distribution, remember, is this exponential thing. The dice example, is sort of looks like it. In fact, if you had enough, dice and you kept averaging their outcome, it would be normally distributed. So lots of things turn out to be normal. One of the properties of normal is that the tail gets small very quickly. Okay, and so you're not going to get very many outliers. The normal distribution is a very common distribution. There are lots of reasons why it should occur all the time, and it's also mathematically very easy to work with. And so economists for a long time assumed everything was normally distributed, but an implication, as I say, of normal distribution is that it's very unlikely something extreme is going to happen because this thing goes down exponentially fast to 0. So you're almost never going to see something way out here. Yet we get these crashes fairly frequently. If every 10, 20, or 30 years or something, there's some gigantic outlier. So clearly things can't be normally distributed, and that's called fat tails. Okay, and I'm sure you've heard about that in the newspaper, and we're going to come back to that. Okay, now there are a couple things that you need to know. So you can represent the payoff of any random variable as a picture, in every state, what its payoff. Okay, so a riskless random variable, riskless investment will pay the same amount in every state. So I still have a few minutes here. Okay, okay, so now 2 incredibly important concepts, which I'm sure you know, or at least the mean you know. Just the average, what's the expected payoff? So the expected payoff is you multiply the outcome in every state by the probability of the state, and you add it up. Okay, so how many different ways? So if you have 1 dice, okay, you can figure out the expectation of 1 dice. It's equally likely to get 1, 2, 3, 4, 5, or 6. And so if you add all those up, multiplied by a 6th, you get 3.5. So the expectation of 1 dice is 3.5. The expectation of 2 die is therefore, okay, so that's 1 dice. Okay, now the expectation of adding 2 dice together is, of course, going to be 7 because the expectation of 1 dice is 3.5 and the other dice is 3.5, and so the expectation of the sum is the sum of the expectations, so it's 7. Okay, so you know that. Now, one more thing that you have to know is the variance. So how do you measure how uncertain you are about what's going to happen? Well, the simplest number to do, like with the dice, is to say, okay, the expectation is 3.5. When we don't get 3.5, it means there was some error. Our expectation wasn't confirmed. So you could just measure the error as the distance between 3.5 and what you actually got. So if you got a 4, you could say you were off by a half. But people don't do that. They measure the square of the distance, okay? And they take the average square of the distance. That's called the variance. Okay, so it would be, if you got 4 when you're expecting 3.5, the error is a half squared. So it's, you take a 6 times a half squared, plus a 6 times 1.5 squared, plus a 6 times 2.5 squared. That's for the high mistakes. And the low mistakes, you take a half times a half squared plus a half times 1.5 squared plus a half times 2.5 squared. Now, why do they use the expected squared error instead of just the expected error? Well, for this simple reason, which you may not have thought of, if you had to guess, if you looked at the error as the penalty for making a wrong guess, and you were forced at the beginning to say, what guess would you like to make for how the dice is going to turn out, how the die is going to turn out, and if you're wrong, we'll penalize you by this measure of error. Well, if you're just taking the absolute error, your best guess would be any number between 3 and 4. You could say 3.5, but you could also say 3.25, because if you said 3.25, you'd become closer on all the low rolls of the dice and be a little further off on all the high rolls, and you'd get exactly the same error. So you could say any number between 3 and 4. But if you make the error the square of the mistake, your best guess is always to say the expectation. 3.5 is the only thing you can say to minimize your expected penalty if the penalty is the squared error. So because of that, that's connected to a mathematical thing, and in orthogonal vectors and all that. Because of that, the error we talk about always is the squared error. And so that's whenever we're measuring uncertainty, we're going to talk about the squared error, the average of the squared errors, or the square root of that, which is called the standard deviation. Okay, I have 1 more minute to just finish this. So I'm assuming you all know that, okay, or can learn that. Okay, one more thing that I'm going to assume you know. The last thing is the covariance. What does it mean to say that random variables x and y move in the same direction? So this was quite a brilliant thought. So what it means is that to move in the same direction means if x surprises you by being above what you would have expected, so if the expectation of x is x bar and the expectation of y is y bar, if you multiply the two and they're both higher than you expected, you'll get a positive number. If they're both lower than expected, you'll also get a positive number. So by taking this sum, the expected deviation from the expectation multiplied, you get a number which, when it's very positive, it means they're either both positive together or both negative together. So they're going in the same direction. If one of them is above the average while the other one's below the average, then you'll get a negative number. So big covariance means they move in the same direction. Big negative covariance means they move in the negative direction. Okay, so I'm going to take it for granted you know this, and we're going to take this up starting right after the exam, which is on Tuesday. All right, so I'm going to finish talking about overlapping generations today. I'm going to defer my plan to save Social Security till a couple lectures from now, and I'm going to start to introduce uncertainty in this class. The exam will only cover the stuff up to basically the last problem set. So you can, there are a few things about overlapping generations I might say today which will clarify what you already know, but you don't have to know anything beyond the problem you turned in on Thursday. You're turning in today. So you, I think, are better informed now than you were yesterday. I think it's a big help to be doing the problems. So for those of you watching on screen at home, do the problems. So remember we had a situation where there were generations, each of whom was rich when young and poor when old, that looked like that. And it went on forever. That was the only difference from what we've had before. People's lives were shorter than the lifetime of the economy. And to go to the extreme, the economy goes on forever, even though people only live 2 periods. And then there was land, 1, 1, 1, 1. So here's land, here's, and then there's there's land, and then there's generation, as I forgot the generation. Here's generation 0, generation 1, generation 2, generation 3, ... And time, this is time. And here's time 1, time 2, time 3, time 4, time 5, etc. Now this model, I've been told, is the hardest thing you do the entire class. Things are going to get much more complicated, but since they build up slowly, I think this model's the hardest thing that you have to do the entire class. So I realize it's a little bit confusing, but in the end, I don't think it's that complicated. And it reveals all the subtlety of Fisher's thinking. Not that Fisher understood about overlapping generations, but his ideas you can see here. So what are his ideas? you've got a complicated model in which you've got people trading apples when they're young against land. So the objects in the economy are land, which you're supposed to think of the stock market. Okay, so we've got land, and we've got land, yes, and we've got apples. So now what's interesting is the land is going to constantly change hands. So the young here are going to buy the land, but when they get old, they're going to sell the land. So the land is constantly changing hands. It's not that one person buys it at the beginning and holds it forever. So Fisher's formula, remember, was that the price of any asset was going to be equal to the discounted dividends. And the logic seemed to be at the time that the price, if the person was going to buy the asset, they could take the money now, or they could wait and get all the dividends in the future, and they would compare, what they would get out of the dividends in the future to what they have to give up today. But you see, in this example, it's a little more complicated. Nobody's going to hold the land and get all the dividends. Each person who buys the land knows that he's going to sell it long before the land is stopped, before getting all the dividends from the land. And yet, the price of the land is still given by this formula. So we never used the fact in Fisher's argument that the same person had to hold the asset till the end. And so now we have a case, an extreme case, where people only hold the asset for one period. It's always turning over, but still the price of the asset is equal to the discounted dividends. So the secret to solving this problem, according to Fisher, is forget about the asset. That makes it too complicated. Fisher's argument, again, is take financial equilibrium. Maybe I should write it on a different board. Fisher's argument is financial equilibrium, okay. Get rid of assets, put dividends into endowments, and transform it into general equilibrium, the very thing you solved in the first couple days of class, okay, and then go backwards and figure out what the financial equilibrium is. So, although it seemed very easy before, it's a little subtler this time, but it's the same principle. Whose endowment should you put the dividends into? The land is changing T, and the young would be given by that. Okay? And I'd have to do this, a new equation for every T. You asked the question, right? So does that make sense? Okay, but I have to do that for every single T. So I have an infinite number of prices and an infinite number of equations. But then you say to yourself, well, this is, if I take the ratio of PT over PT minus 1 to equal P, okay, then the ratio of these two prices is the same as this price. And so I've got, I'll have one equation in one unknown variable, and that same equation will get repeated every other generation. Because when I go to generation, S, which is another generation, all that matters is the ratio between PT minus 1 and PT and PT plus 1. So if I assume those ratios are always the same, I'm going to be repeating the same equation over and over again. So if I can solve it once, I can solve it an infinite number of times. It's basically the same equation written infinitely often. And so as long as I keep these ratios constant, I'm just doing it over and over again. So I only have to do it once. So so it doesn't have to work out that it's, it's just because, every generation has the same endowments and every generation has the same utility. That's why it's such a simple thing to solve. Yeah.
Is the regular P before you erased it then sort of a weighted price that becomes the old age consumption price because we assume young age price is 1?
The P, this P, is just the ratio between, this is how I got P. PT, okay, P is PT over PT minus 1, which also equals PT plus 1 over PT. The ratio of all the prices is always P. Okay, the ratio between time t and time t plus 1, this good is more valuable than that good. This good is only worth p is 0.55. It's only worth 55% of this good. And then this good here is only worth, forgot to write the utility functions, so we have u of consumption when young and old is 1/2 log young plus 1/2 log old. Okay, and so therefore in equilibrium we have to have that 1/2 times the income of every generation. Every generation is going to have 3 when young plus 1 when old. Now from the point of view of any generation t, the prices are p, say 2 when young and p3 when old. Now remember, any generation cares only about relative prices. So I can call them p2 or p3, or I can call them 1 and p, because the ratio is going to be p. So much simpler to think of the prices as 1 and p. So the old guy, okay, if I'm doing any t, like this period 4, the old guy here, that's P4 and P3. He cares about P3 and P4, but he only cares about the ratio of P3 and P4, which is P. So from his point of view, he might as well have thought of them as 1 and P. So his income is 3 plus 1P, and he's going to spend half his income on that good, which for him is a relative price of P. The young guy is going to spend half his income, which is also 3 plus 1P. This is the relative price between t minus 1 and t. This is the relative price between t and t plus 1. But he's now young, so his price when young is 1. And that has to equal 3 plus 1 plus 1 equals, so I wrote it as 1 plus 3 plus 1 equals 5. Okay? And we solved that, and we found that p equals 0.55. Okay? So are there any questions about how we did that? That's where we ended the last lecture. Is that clear to everyone? Yes. Okay, if I didn't have symmetry, I would have to say I would have to write this as, in general, this would be 3 pt minus 1 plus 1 pt over pt, and this guy would be 3 pt plus 1 pt plus 1 divided by pt. Right? That would be, in general, if I had prices, the present value prices, this guy's income would be given by that, because he's the old at times. Changing hands all the time. There's a new guy owning it, a new guy owning it every period. So whose endowments do we increase when we put the dividends of the land into someone's endowment? You put it into the endowment of the guy who owned it first. So put dividends into endowments of original owners. Okay, so this old person who has the right to the first apple, his own endowment of an apple, and also the right to the first dividend, but he actually has a right to all the dividends. So his endowment, the endowment of Mr. Zero, okay, is going to be 2, 1, 1, 1, etc. Because he has his original apple, plus he's got, and he has his endowment of an apple, because everyone when they're old has an apple. He's also, because he's owned the land before, gotten the right to this first dividend of the apple, that's 2. And because he's the original owner of land, he owns all the future dividend streams of the land. Okay, so we can forget about land after we've stuck the dividends into the right person's endowment, and now we just trade as if it's general equilibrium. We just look for supply and demand and the present value prices, which are P1, P2, P3, etc. Okay, and because it's symmetric, we know that this is going to equal 1 P. We can always make one of them be, one price can be 1. So the present value prices are going to look like this. Okay, and the reason I can make this simplification is by symmetry. Every generation is the same. So it's obvious that I'll be able to keep repeating the same argument over and over again. Okay, and so what do I have to, okay, so remember, the land has disappeared here. Even though this generation is buying the land and selling the land, in Fisher's story, you don't have to pay attention to that. This guy bought the land and then he sold the land. So he, it was a fair trade. So he started, he started without it and ended without it. The fact that in between he used the land to save, You can already do that in a general equilibrium. You don't need to think about the land, because the only reason this guy is buying the land is to use it for a means of saving, which is already in Fisher's equations. So to solve for equilibrium is then quite simple. We just, in every generation, we look at, and remember I